Friends, welcome back to our channel OMSAI Bhojanapalli.
The Sunday's class, we completed the foreign exchange management, a brief introduction to the area, time value of money. We started doing the bond concepts, in which we have completed discussing about valuation of a bond and calculation of yield to maturity. Today we will be doing the following concepts. Realized yield to maturity, we will be discussing a concept. Number 2, concept of duration and volatility of a bond. Once we complete that, I will do once again value, yield to maturity, duration and volatility for an annuity bond, for a perpetual bond, for a zero coupon bond. Because till now the bond instrument which we are discussing is a coupon paying bond which pays coupon for n years and redeems at the nth year. So we will be discussing the same concepts for the remaining bonds. Nothing great, some small changes here or that, that's all. All this we will try to cover in today's class, so that next class we will start with the other areas. We will try to complete bond immunization strategy and horizon analysis in the next class. Before that, let us summarize what is done in this bond chapter till now. I will continue with the concept of realized yield to maturity next. Companies require assets to generate profits. Please settle down, don't talk. Companies requires assets to generate profit, and the assets requires funding. Two broad sources of funding may be equity and then debt. We classify it as equity and debt in the way in which they share the profit generated by the asset. If a person wants a fixed income from the funding, he will be called as debt. When a person is willing to take a risk and opts for a variable income, he will be called as equity. The fixed income securities only we are discussing in this chapter. We will be discussing in the chapters like interest rate swaps, interest rate risk management, currency swaps, etc. These fixed income securities can also be popularly called as bonds. There are so many fixed income securities, T-bills, Government of India bonds, it may be corporate bonds, debentures, but everything I just give a common name here called as bonds. So there is a separate market for this bond. How in the stock exchange, NSE or BSE, we have the shares traded, same way corporate bonds are also traded in the stock markets. The principles as well as the various issues relating to this bond instruments only we are discussing in this chapter, bond valuation. I said that there are 4 types of bonds generally we can classify based on the cash flow pattern, namely plain bond, annuity bond, perpetual bond and zero coupon bond. A plain bond gives its bondholder coupons for n years and redeems in the nth year. An annuity bond pays every year annuities. Annuities are very similar to EMIs, where it compensates for coupon as well as a principal portion. In case of a perpetual bond, it pays only coupon forever but does not redeem the bond. Zero coupon bond does not pay coupon, only pays the maturity value in the nth year. I said in the first discussion of this chapter, first session of this chapter, we will discuss how to calculate value, yield to maturity, duration, volatility for all these 4 types of bonds. Then we will be discussing other issues like concept of realized yield to maturity. The next concept is bond immunization, horizon analysis, forward rates, then convertible bonds, convexity of bonds, then bond refunding decisions. All the other issues will be discussed in the next stage of this chapter. Here we discuss first the value of a bond. Not only a bond, value of any asset using discounted valuation method is as follows. Value of an asset is the present value of the future benefits from the asset discounted at required rate of return of the valuer. Here there are two things which influences the value. One is the future benefits and number two is the required rate of return. For example, for a bond investor, the future benefits are the cash flows which they get from the bond instrument, and the discount rate or the required rate of return depends on the certainty of the future benefit. If the future benefits are very certain, then I will require from that asset a lesser return. If the future benefits are very risky, uncertain, I require a higher return. So the required rate of return depends on the certainty of the cash flows from the asset which is valued. So here we saw a bond value is the present value of the future cash flow the bondholder gets from the bond discounted at its required rate of return. We saw how to value a annual coupon paying bond, how to value a bond which pays coupon semi-annually, how to value when you have a multiple discount rates, and how to value when the coupons are multiple coupon rates. First for some we dealt with the value of the bond. Then we said that in first four sums, they gave me the cash flows. They said this is what the investor wants, and we found out the bond value. The decision is if the actual value of the bond in the market is more than the value which you have priced, in that case the bond is overpriced, you will not buy it. If the actual value of the bond in the bond market is less than what you have valued, then the bond is priced, you will be going and buying the bond. If the actual value is same as what you have valued, then the bond is perfectly priced. If you buy a overvalued bond, it will give you a return less than what you require. If you buy an undervalued bond, it will give you a return more than what you require. If you buy a perfectly valued bond, it will be exactly giving you what you require. And I said, when a bond is purchased and redeemed at par, then the return the bond gives is its coupon itself. It's purchased at other than par. Suppose I purchase a bond at discount, then apart from coupon, I will also be earning a capital gain. If I pay more than the par value to buy the bond, then I will be having my coupon income eroded through the capital loss. This is what has been discussed in the first stage of the chapter, right or not? Then we discuss about yield to maturity. What is YTM? YTM is the return the bondholder gets from the bond if he holds the bond till maturity. This YTM can be calculated in three ways: Formula 1, Formula 2, Formula 3. What is Formula 1 for calculating YTM? Interest after tax plus amortization divided by average price. What is Formula 2? Interest after tax plus amortization divided by weighted average price. What is average price? S plus M by 2. What is weighted average price? 0.6 S plus 0.4 M. And the best method and the logical method to find out YTM is the IRR of the bond cash flows. Even to calculate IRR, we should know where to start our IRR calculation. For that, we can use the shortcut formula and then do the IRR calculation. Where S means subscription price, M means maturity value, amortization is M minus S divided by N. This is what we discussed in the yield to maturity. Up to this, everybody, are you having the clarity or not? No. We'll move on to the next concept called as realized yield to maturity. Give the heading realized YTM. Realized yield to maturity. This concept is not new to you. We have already discussed in some other name in IPSC called as modified IRR. Well, remember or not? There's something else modified NPV, modified IRR. There's nothing but a modified IRR concept. But still, I don't want to take a chance. I'll discuss this independently without linking it to the modified IRR. Can I start or not? Now, see. Let us take the first sum which we did. You all remember the first sum or not? Now, there's a bond triangle. We have the value of the bond. influenced by two factors, cash flow from the bond and then the return. We had all the three numbers in the first sum. Tell me how much is the value of the bond? What the price of the bond? Correct value of the bond is how much here? Tell me the number. 80, 86.59. What the cash flow of the bond gives? 1 to 5 years gives you 11 rupees. Fifth year gives you 100 rupees. And we saw the YTM is how much percent? 15%. In other words, when I invest, how much rupees? 86.59, and the bond gives me these cash flows. I am said to be earning how much return from the bond? 15% return from the bond is what we understand. Everybody following or not? No. This is the yield. The bond gives its bond holder. What the yield is bond gives its bond holder? 15%. Just to confirm, if you buy at 90 rupees the same bond, will I earn 15% or not 15%? Not 15%. More or less? Less than 50. If I buy the same bond at 80 rupees, what happens? I will earn more than 15%. If I buy the bond at 100 rupees, what is that? I'll earn the 11% coupon and so on. Everybody following or not? No. Now I am going to discuss more deep into this concept of how the investor earns 15% or when the investor cannot earn 15%. That's the issue. Let us discuss deeply this particular concept. Nothing, we need to have a predetermined notion. Follow my calculations or discussions. Okay, whatever I tell, then I'll give you a final conclusion and summary of what is being discussed. This concept of realized YTM is very important. Independently, it is asked as an examination problem. It is also one of the concepts inside the bond immunization strategy later. Can we start or not? No. Now, you pay how much rupees to buy this particular bond? First question I am doing. How much you pay to buy the bond here? 86.59. Every year, will you get some money from the company here? You get 11 rupees in first year, 11 rupees in second year, and so on. When you get a coupon of 11 rupees, will you put in pocket a reinvest? Okay, always compounding assumes reinvestment. I am going to reinvest. Suppose I assume that I am going to reinvest the money received at 15%. What percent? 15%. What is so sacred about 15%? YTM. The YTM of this bond is 15%. So, I now assume that not only in this bond, whatever money the bond gives me, I will be in a position to invest back that money at what? Yield to maturity. That means the assumption is I can find similar bonds once again that can give me what? 15% is an assumption. In that case, let us see what is happening and then proceed further. Can we start or not? No. This I call as a reinvestment table. The columns are year, events, cash flow, maturity value, calculation and amount. Can we start or not? No. Very simple. First year, let's take first year. You get any money from the bond? Yes. What do you get? Coupon. How much coupon you get? 11 rupees coupon you get. Now tell me, when you get 11 rupees coupon, you immediately go and what? Invest. Okay. Now, I will invest at what percent? Assumption I am now making, I am going to invest at what percent? 15%. For how many years? 4 years. Because I get the 11 rupees at the end of the first year. Count end of the second year, end of the third year, fourth year, fifth year. How many years I invest? 4 years. Tell me what is a compounding factor? 1 plus r power n. Yes or no? Because the amount invested into 1 plus r power n gives you the maturity value. Right or not? Future value is equal to present value into 1 plus r power n. Respond. Yes or no? No. I invest 11 rupees at 1.15 power 4. It will mature to 19.239. You can believe my calculation. Can I proceed or not? No. Tell me how the 11 rupees becomes 19.239 rupees along with the 15% compound interest for 4 years. This will be the money I will be getting. Everybody respond. Yes or no? No. Similarly, second year, I get another coupon. I get another coupon of how much rupees? 11 rupees. Now, this 11 rupees I invest once again for how much percent? 15%. For how many years I invest? 3 years. Tell me the maturity value will be 16.729. Third year, I get the third coupon. How much rupees? 11 rupees. I invested that 15%. For how many years? 2 years. It will mature to 14.547. Fourth year, I get another coupon. How much rupees I get? 11 rupees. I invested 15%. For how many year? 1 year. I will be getting 12.650. Last year, fifth year, I get coupon and then what? Redemption. I get how much rupees? 111 rupees. 11 rupees coupon, 100 rupees redemption. I invested how much percent? 15%. For how many years? 0 years. Because I get only on the last day, I could not invest. Anything to the power 0 is what? 1. So it is going to give me how much? 111 rupees. Everybody comfortable or not? No. My question is, can I add 11 plus 11 plus 11 plus 11 plus 11, 55 plus 100, 155 and write it or not? No. Time value of money prevents me. Can I add the last column? Yes. How we calculate present value? We can even calculate the future value. All that amount is in which term? Fifth year term. It can be added or not? Yes. The amount that is going to be, I am going to get is 174.16. What is the amount here? 174.16. Now, simply understand like this. Today, how much money I put in the bond? 86.54. Every year, when the bond gives me 11 rupees, I don't take it home. I once again what? Reinvest. At the same bond as some other companies bond. At how much percent? 15%. That means, first 5 years, imagine that I don't take any money home. Yes or no? At the end of the fifth year, if you see my passbook balance, what the money will be having? 174.16. The bond has given me only 155. It has given only how much rupees? 155. But I got how much? 174.16 because apart from what the bond gives, I also what? Reinvested at 15% and the money in my hand is how much? 174.16. This clarity, everybody following or not? No. I'm not concluding anything. I have to do few more calculations and then I'll start with my discussion. Can you proceed? Now, like this you imagine. Today, how much I invested? 86.59. Did I get anything in first year? Anything in second year? Anything in third year? Oh, no, Suliya. Yeah, I'll start from the first year. How much I invested today? 86.5. Tunga, did I get anything in first year? Anything in second year? Third year? Fourth year? Fifth year? Yes. At the end of fifth year, I got how much? 174.16. The bond gave you 11 rupees, but I did not take home. I just what? Reinvested back. So only at the end of fifth year, I am taking the entire money home. How much rupees here? 174.16. Respond is or no? No. If you imagine, it is something similar to your bank FD. Correct? I invested some money today. For 5 years, a cumulative maturity value will be there, right or not? Same way, I made a thing like this. I made an FD for 86.59, which has a maturity value for 174.16. This should have earned me some return or not? That is the IRR of this FD. Are you following? Correct? We should calculate what? IRR. Now let us see how to calculate the IRR. Very simple. IPCC, time value of money, rate of return calculation. Can we start or not? Now, tell me. Future value is equal to what into what? Present value into 1 plus R power n. Right or not? Now, see. Future value is equal to present value into 1 plus R power 5. 5 years problem now? Now. What is the future value? Maturity value. What is the number? 174.16 is equal to what is the present value? 86.59. Has grown at what percent? Some R percent. For how many years here? 5 years. If you can solve for R, I will be getting the rate of return. Yes or no? Now, if I rearrange, I get 174.16 divided by 86.59 is equal to 1 plus R power 5. Is equal to 1 plus R power 5. Yes or no? Now, that means fifth root of 174.16 divided by what? 86.59 is equal to what number? 1 plus R. It is 1 plus R is equal to, I'll get 1.15. If I take fifth root, I'll be getting 1.15. R is equal to how much percent? 0.15 or 15%. That is from this investment, I'm earning how much percent return? 15% return. One calculation I'll tell you is very important. You should know from the CPT itself, but still we use this very frequently throughout the subject. How to find out fifth root of a number in the calculator, right or not? We should try to find out anything we should be able to do in the calculator without anybody's help. Can I proceed? Now, I'll discuss that alone and don't create commotion. We can just go home and try. This is how it should be done. Okay, now. Let us start this. 174.16 divided by 86.59. I want a number. What is the number here? 174.16 divided by 86.59. What is the number? Okay, 2.0113. I want to tell you how to calculate fifth root of 2.0113 in the calculator. If you know to calculate fifth root, when even calculate 27th root, when even calculate what? Ninth root, any number one can what? Calculate. The calculation procedure is simple except for the appropriate number change. That's all. Everybody following or not? No. Because I will use this even in annuity bonds, in perpetual bonds. I'll use this throughout the subject in portfolio and other chapters. Just only information how to do the calculation. In CPT itself for calculating WDV rate, this calculation has been used by you, right or not? Then I'll leave it here. Let me now tell you first. Now, don't laugh. I am saying how to do it. Take the calculator. Type 2.0113. Type on here. Take the calculator. So type 2.0113. Have you done that or not? No. Do what I say. Next, what you do is there's a square root button in the calculator or not? You press that 15 times. Press it how many times here? 15 times. 1, 5. Press it how many times? 15 times. Press square root 15 times. Now, this is very simple. Just first time if you know it, enough. Press square root 15 times. Are you all doing? Huh? Okay. Now, next what you should do is minus 1. Don't press any other key. Press minus key and then 1. Minus 1. Don't do anything. Minus 1. Okay. Now, tell me which root you want? Fifth root. So, divided by 5. Divided by 5. Don't press is equal to divided, say key and then what? 5 key. Then what do is plus 1. Plus key and then 1 key plus 1. Then what you should do is take both the hands. Into is equal to press 15 times. I am squaring it back. Into is equal to 15 times. Now, final level I am telling here just for usage. Okay, into is equal to 15 times. Somebody should have done it. Into is equal to what is the number here? 1.15. We're getting how much? 1.15. So this 1 plus r is equal to 1.15. R is equal to what? 0.15. Don't clap for all this. Yeah, at least I clap for swap valuation worth. Okay, now please. ரொம்ப simple. Now, have you by hearted? Type the number. What do you do? Type the number. Press square root how many times? 15 times. Minus 1. Divided by what root you want. Plus 1. Into is equal to 15 times. Now, just one thing. Cube root of 27. What is cube root of 27? 3. Is it correct? Stop talking. Cube root of 27 is 3. Accepted? Let's see how to find out. All of you tell me. What should you do first? 27. Type what? 27. Then what you should do? Press square root how many times? 15 times. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. Okay or not? Now, next what I should do? Minus 1. I want what root? Cube root. So, divided by 3. Then what I should do? Plus 1. What I should do? Into is equal to 15 times. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. I get how much here? 3. Everybody following or not? Now, Mokka concept here. I have to go for all realize YTM only. Okay. Just to help you in doing the calc, because you should not find last. Sir suddenly put in the slide 1.15. How I got it? One should be knowing how to do it or not. Hence I thought you this will be using throughout. Okay. All this you can copy later. Now tell me how much I have earned? 15%. Please. Shh. Let us start with our concept. Very simple, small concept only, important. Okay. Now, today I put into the market how much rupees? I put into a fixed income security market 86.59. Only After 5 years, if I am having in my hand 174.16, I am said to be earning 15% return. Right or not? Isn't it correct? Huh? Now, understand the scenario. I put 86.59 in the market. Only after 5 years, if in my pocket, how much rupees? 174.16, I will be earning how much return? 15% return. If after 5 years, suppose I have 190 rupees, I will be earning more than 15 or less than 15 or more than 50. I have only 160, I will be earning more than 15, less than 15 or less than 50. This first point, are you have the clarity or not? Now, understand that. To get 174.16, two things should have happened. What should have happened here? Two things should have happened. Number one, the bond should have given me for the 5 years 11, 11, 11, 11, 11 and then what? 100 rupees. Yes or no? That is alone not enough. I should have invested it back at 15% return. Yes or no? Now, so if I don't invest, all amount the bond gives, if I put in my pocket, I consume, in that case, I would have having only how much rupees? 155 at the end of 5th year. Yes or no? So, 89 invested, 155 at the end of 5th year will give me the desired 15% yield. No. Yes or no? No. That is, I can earn that 15% yield only if I am able to reinvest the bond cash flow at what? YTM, yield to maturity. Everybody following or not? Now, from this, you should understand the wordings carefully. Two things. Bond gives me an yield of 15%. That is true. Bond gives me what? An yield of 15% because 86.59 IRR, 11, 11, 11, 11 and 100 is going to be how much? 15%. Bond gives me 15%. Yes or no? But for me to sustain that 15%, I should invest it back at what? 15%. Yes or no? So what bond gives me is called as yield to maturity. What I ultimately realize is called as what? Realized yield to maturity. Yes or no? Yield to maturity is a duty of the bond. Realized yield to maturity is what I do with the bond cash flow. Are you following? So something, yeah? Very simple. What I teach you is yield. Forex or not. What it is what? Yield. Okay. Have taught you everything, you don't revise. Then you forget. That means your realized yield is zero. Are you following what I am saying? So, if I myself does not teach, then the yield is zero. But suppose I have taught you, but you did not want to sustain it through revision, then the realized yield what? Reduces. Suppose I teach you and you revise more and do more research in net and other books and you learn more, then realized yield is what? More than what I have taught you. So no. So everything depends on not only what the bond gives, it also depends on what? What you do with the money given by the bond instrument. Are you following? This we call as what? The concept of realized yield to maturity. Everybody yes or no? No. Very simple. The bond gave me 15%. Na? If I am able to reinvest the money at 15%, I will be realizing myself also what? 15%. Bond gives me 15%. But when the bond cash flow comes, if I am able to go back and invest at 16 or 17%, what I earn will be more than what the bond gives or not? Yes, because I invest back at more than yield to maturity. Instead of 1.15, if I invest the money at what? 1.16, this will be 174, less than 174, more than 174. The bond has given me 15%. By invested back at what? 16%. My realized yield will not be 15. Will be what? More than 15%. Yes or no? Suppose a bond gives me 15%. In the next year and all over the world, interest rate has what? Crash. I am able to invest back only at 9%. Tell me, will I sustain the 15%? No. What I earn is ultimately less than 15%. So now tell me, an investor's yield depends on two factors. One is what? Bond gives. Number two, what he does with the money given by the bond. Yes or no? What the bond gives is called as what? Yield to maturity. What he does is called as reinvestment rate. Is called as what? Reinvestment rate. The yield and the reinvestment rate gives you what? The realized yield to maturity. Everybody following or not? So, this YTM the IRR. YTM is called as what? IRR. In IPCC, I understood that when I say a project gives me 15% IRR, suppose this is a project, it gives how much IRR? 15% IRR. We said the assumption is, when a project is giving me 15% IRR, the inherent assumption is that I am able to reinvest back the project cash inflows every year back at what? 15%. Then only I can say, my realized IRR is 15%, yes or no? suppose I can invest the project money back only at cost of capital rate or at 11% or 12%, then I'll be getting a different IRR. What I earn? Yes or no? That IRR I call as what? Modified IRR. Right or not? IRR is what the project gives. Modified IRR is ultimately what the company earns along with what it does with the money the project is giving you. Everybody following on? We discussed it in the IPCC, modified NPV and modified IRR. That is what we call here as what? Realized yield to maturity. Everybody understanding this concept or not? Now, calculation simple. How to calculate realized yield to maturity? In the sum, I invested back at what percent? 15%. In examination sum, they say, I will be investing back at 10% or 11%. Some different number will be given. Then only we can differentiate between YTM and what? Realized YTM. Then we have 3 steps. First step is to do the reinvestment table. Whatever money it comes, you invest back at what? The interest rate given in the question. You first find out this table. This table I give the name called as what? Reinvestment table. Second step is to write the overall summary cash flow. This is the overall summary cash flow. And third step is to calculate what? IRR. That's how I calculate. And this will be called as realized yield to maturity. This is incidental only for to understand how to calculate nth root of a number in a calculator. With this, the brief discussion about realized YTM is completed. Everybody understanding it or not? Okay, now let's have the solution. There is this example copied. Before let's consolidate and then copy. Now tell me, how much I invested in bond? 86.59. What the bond gave me? 11 rupees for 5 years. How much end of 5th year? 100 rupees. From the bond, I have earned how much yield? 15% yield. But I will say I will earn 15% yield only if I reinvest back the money at what? 15%. That real which I take is called as what? Realized yield to maturity. What the bond gives is yield to maturity. What the bondholder ultimately earns is what? Realized yield to maturity. What the bondholder ultimately earns depends on 2 factors. What the bond gives and what he does with the money given by the bond. If he is able to reinvest back at a rate more than YTM, his realized YTM will be more than YTM. If he is able to invest back at a rate less than YTM, his realized YTM will be less than YTM. If he is able to invest back exactly at YTM, his realized YTM is equal to YTM is the issue. Everybody have the clarity or not? With this we complete this concept. Give that thing, concept of realized YTM. Write down. Point number 1. Point number 1. In question 1, we understand this concept with the help of the example of question number 1 itself. Let us have a flow, okay, in a speaking tone. Point number 1. In question 1, investor invested. In question 1, the investor invested. The investor invested. How much rupees? 86.59. The investor invested 86.59 in a bond. In a bond which gave him 11 rupees coupon for how many years? 5 years. Which gave him 11 rupees coupon for 5 years and 100 rupees in 5th year. And 100 rupees in 5th year. Can I proceed? Point number 2. The yield the bond gives its bondholder is, point number 2, the yield the bond gives its bondholder is, how much percent? 15%. The yield the bond gives its bondholder is 15%. Can I proceed? Point number 2 or 3 and 3. Suppose the investor is able to invest. Suppose the investor is able to invest the bond cash flows. Suppose the investor is able to make a small change, reinvest the bond cash flows. Suppose the investor is able to reinvest the bond cash flows at 15%. Suppose the investor is able to reinvest the bond cash flows at 15%. His reinvestment table looks as follows. 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 Please copy this particular slide. His reinvestment table looks as follows. Copy this slide. Finish copying up. Shall I proceed? Those not copy, raise your hand. Shall I proceed above? Finish copying up. Shall I proceed? Now, write down. Point 3 or 4? Point 4. His overall cash flow can be summarized as follows. His overall cash flow can be summarized as follows. Year cash flow. His overall cash flow can be summarized as follows. Year cash flow. Year 0, 86.59, investment na outflow. Year 0, 86.59, it is an outflow. Year 5, how much he got? 174.16. Year 5 he got 174.16. 174.16. Shall I proceed or not? Continue, same point. He put 86.59 into the market. He put 86.59 into the market today. He put 86.59 into the market today and realized 174.16 and realize 174.16 through bond cash flows and reinvestment incomes, and realize 174.16 through bond cash flows and reinvestment income, and realize 174.16 through bond cash flow and reinvestment income after how many years? 5 years. And realize 174.16 through bond cash flow and reinvestment income after 5 years. Next, point number 3 or 4 or 5? Point number 5. Here's ultimate return. His ultimate return from the market. His ultimate return from the market is calculated as follows. His ultimate return from the market is calculated as follows. His ultimate return from the market is calculated as follows. Okay. Please copy this slide. Future value is equal to, write along with me, future value is equal to present value into 1 plus r power 5. Future value is equal to present value into 1 plus r power 5. What is the future value? 174.16. 174.16 is equal to, what is the present value? 86.59 into 1 plus r power 5. 86.59 into 1 plus r power 5. 174.16 divided by 86.59. 174.16 divided by 86.59 is equal to 1 plus r power 5. Is equal to 1 plus r power 5. You can simplify and write fifth root of, what the number? 2.0113. Fifth root of 2.0113 is equal to 1 plus r. Fifth root of 2.0113 is equal to 1 plus r. That means what is 1 plus r is equal to 1.15. 1 plus r is equal to 1.15. R is equal to, reduce 1 from 1.15 gives how much? 0.15. 0.15 means how much percent? 15%. R is equal to 0.15 or 15%. R is equal to 0.15 or 15%. Everybody having the clarity or not? No. Don't get irritated, don't laugh, just for to note it down. Once you write down, you can just do it every time in the class later. Okay. Point number 4 or 5 or 6 or 6. How fifth root of 2.0113 calculated? How fifth root of 2.0113 calculated? Don't write in the examination. Okay. Just for you to have a grip. How fifth root of 2.0113 calculated? Okay. Sometimes may seem childish, but may be useful for number of persons. Same, just giving it. Okay, fifth root of 2.0113. Please note it down. Here, one thing here, only change in every calculation is this 2.0113 may change. I want a ninth root of 500. Now this number becomes what? 500. Another change is divided by 5 in a fifth root. If I am going to find out cube root means what? Divided by 3. Apart from the first and this number, all the remaining are what? Same. I am just doing a thing and then reversing it. I take square root and then do what? Minus 1. Then I reverse it by what? Adding 1 and then into is equal to squaring it. Everybody following an order, and really the changer is 2.0113 and divided by 5. Okay. Note down this quickly. You finish copying, huh? Respond, yes or no? Those who are not copy, raise your hand. Shall I proceed? Now, point number 6 or 7? 7. The investment of 86.59, the investment of 86.59 is said to have yielded a return of, investment of 86.59 is said to have yielded a return of 174.16 is said to have yielded a return of 15%, an investment of 86.59 is said to have yielded a return of 15% only if we have only if we have rupees 174.16 at the end of 5th year. Only if we have rupees 174.16 at the end of 5th year. Only if we have rupees 174.16 at the end of 5th year. Everybody understanding my point or not? When this 86.59 is said to have earned me 15% return, only if we have what? 176.59 at the end of the 5th year. Can I proceed? Point number 6 or 7 or 8 or 8. To have 174.16, to have rupees 174.16 after 5 years, to have rupees 174.16 after 5 years, two things should have happened. Two things should have happened. Two things should have happened. Branch it into two. Two things should have happened. Branch it into two. First branch. The bond should have given an yield of, first branch, the bond should have given an yield of, how much percent? 15%. The bond should have given an yield of 15%. The bond should have given an yield of 15%. And second branch, right? Second branch. The bond cash flows should have been invested back at, second branch, the bond cash flows should have been invested back at, a reinvestment rate of, the bond cash flow should have been invested back at a reinvestment rate of, how much percent? 15%. A reinvestment rate of 15%. Can I proceed? Next. Point number 6 or 7? Sorry, point number 9. There can be three situations. There can be three situations. Branch it into three. There can be three situations. Branch it into three. First branch, reinvestment rate greater than YTM. First branch, reinvestment rate greater than YTM. Guess, what is the second branch? Reinvestment rate is equal to YTM. Reinvestment rate is equal to YTM. Third branch is what? Reinvestment rate less than YTM. Third branch is reinvestment rate less than YTM. Tell me what are three situations? Reinvestment rate greater than YTM is equal to YTM less than YTM. First branch, put the down and write. Realize YTM. First branch, right? Realize YTM greater than. Greater than what? YTM. Suppose I don't invested 15, I invested what? 17%. I ultimately realized 15, more than 15, more than 15. Realize YTM greater than YTM. Second branch, realize YTM is equal to YTM. Bond also gives me 15. I also reinvest back at what? 15. Realize YTM is equal to YTM. Third branch, what is third branch? Realize YTM less than YTM. Realize YTM less than YTM. Realize YTM less than YTM. Point number 10 above. Point number 10. To conclude, YTM is what? To conclude, YTM is what the bond gives its bondholder. YTM is what the bond gives its bondholder. YTM is what the bond gives its bondholder. And realize YTM is what the bondholder, and realize YTM is what the bondholder ultimately earns. And realize YTM is what the bondholder ultimately earns. Full stop, continue. How much he ultimately earns depends on how much he ultimately earns depends on the return given by the bond. How much he ultimately earns depends on the return given by the bond and his reinvestment rate. The return given by the bond and his reinvestment rate. The return given by the bond and his reinvestment rate. In essence, the last point only we discussed so much. Yes or no? We discussed only the last point. What is YTM? What is realized YTM? What is reinvestment rate? From this we can know that we have seen 3 percentages. Yes or no? What 3 percentage here? YTM. Second is what? Realized YTM. And third is what? Reinvestment rate. YTM is what the bond gives. Reinvestment is what? The rate that is the bond cash flows are invested back. And realized YTM is ultimately what he earns. Apart from that, there is also coupon percentage. Now we are seeing so much percentage. Unless you have clarity, you will be getting confusion in the examination which percentage. Till now, if I say percentages, I have seen how many percentage? So many percentage. Coupon percentage is what the company pays. It is used to calculate the cash flow, right or not? In this sum, what is the coupon percentage? The company gives a 11% coupon, right or not? But is a bondholder earning 11% from the bond? No. He earns 11%, 15%. Why he is earning more than coupon? Because he is having a capital gain as a second percentage. Yes or no? Now, the bond is giving him 15%, but he is ultimately earning how much percent? It depends on how much he reinvests. So something called as reinvestment rate in the aforesaid problem. Yes or no? And finally, after he reinvests, how much he earns? I call as what? Realized YTM. Respond. Yes or no? You name the 4 percentage in the chapter here. Coupon percentage, YTM percentage, reinvestment rate percentage and realized yield. All this one should be having full clarity when you read the question. The clarity can be obtained only when you discuss so elaborately. Everybody yes or no? Not only discussion important. What is important? Revision. Discussion is like YTM. Revision is what? Revision is what? Reinvestment rate. Ultimately what remember is what? Realized YTM. I am not joking, yeah, no punch dialogue. I am saying reality because this happens. Classroom, now you understand this very clearly, right or not? But after 4 or 5 chapters, when discussing our portfolio, suddenly I use realized YTM, you look blank. I'm saying because it is not your fault. Human memory fades. When new things come, old things are what? Forgotten. But how to remember old things? To once again recollect, revise, there will be much more grip. Yes or no? Very simple. Yeah. Father, mother is there. In childhood, people remember father, mother very fondly. Yes or no? Okay. After getting married, will they remember or not? Okay. Some extent is not remembering. Okay. Suppose the parents die. The parents what die, I'll say daily basis they remember. Yes or no? Once in a year when the ceremony comes, what happens? They remember. Because human memory is what? Very fast, forgetting things. How to remember? If you keep on recalling how the parents have what helped you or how they have just showed love on you, then what happens here? We're remembering them throughout. Are you following or not? Now, same thing, Tendulkar, right or not? Now, daily basis when Tendulkar is batting, people remember him. Yes or no? Now you all remember Tendulkar or not? To some extent. I ask the same question after 20 years. That will be some other person. Yes or no? I don't want to say Virat Kohli and all. Okay. Gold is yeah. Can I proceed? Now, let's go for the next one. With this, we complete the concept of realized YTM. We'll do one problem in this area before we go for the next. Forget concept. 3 steps are that. First step is to prepare what? Reinvestment table. And second step is to write this summary. And third step is to calculate the IRR. Can quickly complete question number 8 or not? Then we'll go for the volatility and duration of a bond. Can we start? Take question number 8, please. Now stop talking. We will do it together. We'll do the calculations together. Please. A rupees a rupees 1000 par value bond carries a coupon rate of 10%, payable annually and has remaining maturity of 4 years. The bond is presently selling for 1020 rupees. Reinvestment rate applicable for the future cash flow of the bond is 9% per annum. What will be the realized yield to maturity? Now, in the bond market, the company's bond is trading at how much rupees? 1020 rupees. It's a primary market price or secondary market price? Secondary market. Always time of the issue only will be having the primary market price. Then it starts trading in the secondary market. It's now trading at a price of 1020. How many more years the bond is having for the maturity? 4 more years. For another 4 years, the company will give the bond holder, whoever is holding the bond, what return? 10% coupon, calculate on what face value? 1000 rupees face value. At the end, they will be redeeming, nothing said na, it is assumed to be redeemed at par. Now, whatever coupon you receive, you put in pocket, reinvest. We are going to reinvest at what rate? 9%. The question is given a reinvestment as a 9%. The question asks you to calculate the realized yield to maturity. That's all. Yes or no? Now, I'll add one more question just for the sake of grab. Also calculate YTM. Also calculate YTM. Just add one question to this. Also calculate yield to maturity. Also calculate YTM. Also calculate yield to maturity. Now, can we do the sum together? No, I don't. Step 1, please. We are now going to calculate realized YTM now. What is step 1? Reinvestment table. Right, step 1, reinvestment table. Step 1, reinvestment table. Please. Tell me the columns. Year, even, cash flow, maturity, value. In the 2 columns, calculation, amount. Can I proceed above? No. Simple. First year, right? Year 1. What is the even? Coupon. When you buy the bond today in the market at 1020, first year company sends you a coupon check. Yes or no? Gives you a coupon. How much coupon? 10%. And how much par value? 1000. How much you receive? 100. This 100 rupees coupon you take home or invest back? Invest back. At what percent? 9%. The question says the reinvestment rate is 9%. So into 1.09 power, tell me how many years? 3 years. And end of first year I got na, end of second year, third year, fourth year. 1.09 power 3. 100 into 1.09 power 3. If you can calculate it, tell me what is the number? 100 into 1.09 power 3 gives how much maturity value? 129.5. 100 is the principal, 29.5 is the compounded interest. Respond, yes or no? No. Second year. Once again, second year, the company gives me one more coupon for how much rupees? 100. This I invest back at 9% for how many years? 2 years. 100 into 1.09 power 2. I invest back at 9% for 2 years. What's the amount I am going to get? 118.81. 118.81. Once again, I get the coupon in third year. I get a coupon once again in third year. How much I get as coupon? 100. I invest back at 9% for 1 year. 100 into 1.09. 100 into 1.09. What is the maturity value? 109. Maturity value is 109. Fourth year, I get a coupon. I'll write separately in this slide, not an issue. Fourth, I get a coupon. How much coupon? 100. I invest back at 9% for how many years? 0 years. 100 into 1.9 power 0 means what? 1. Anything raised to 0 is 1. The amount is 100. Again on fourth year, I get one more cash flow called as what? Redemption. I get one more cash flow called redemption. Fourth year, one more cash flow, redemption. How much the company redeems me? 1,000. Since nothing said about premium, etc., redeemed at par is assumption. Here is 1,000 into 1.09 power 0 is 1,000. The amount is 1,000. 1,000 into 1.09 power 0, amount is 1,000. Can I add the cash flow column? No. But can I add the last amount column? Yes. Everything is in fourth year term. Tell me what is the amount column? Tell me the number it is 1457.31. 1457.31. 1457.31. Can I proceed or not? No. Step 1 over. Can I proceed? Step 2. Summary cash flow. Step 2, summary cash flow. I hope you are understanding and doing it. Step 2, summary cash flow. Year cash flow. Today, year 0, how much you invested in bond? 1020. You invested 1020. At the end of the fourth year, how much money I have in hand here? 1457.31. 1457.31. 1457.31. This calculation is very simple because fourth root means 2 times plus square root will be getting the answer automatically. Can I proceed? Now, step 2 or step 3? Step 3. Calculation of realized YTM. Step 3. Calculation of realized YTM. Step 3. Calculation of realized YTM. Okay, tell me, what the formula? Future value is equal to present value into 1 plus r power 4. Future value is equal to present value into 1 plus r power 4. Tell me what is the maturity value I am having? Tell me the number of future value. 1457.31 is equal to 1457.31 is equal to what is the present value? 1020 into 1 plus r power 4. 1020 into 1 plus r power 4. Rearrange. 1457.31 divided by 1020 is equal to 1 plus r power 4. Is equal to 1 plus r power 4. Can tell me a simplified number. 1457.31 divided by 1020. Tell me the number what I get here. Tell me the number. What is the number? 1.40? 4287. Okay, 1.4287. Right. 1.4287 is equal to 1 plus r power 4. 1.4287 is equal to 1 plus r power 4. 1 plus r is equal to, please tell me 1 plus r is equal to what? 4th root of 1.4287. 1 plus r is equal to 4th root of 1.4287. 4th root and all don't say square root 15 times etc. Just 2 times square root gives you what? 4th root. Correct? I cannot teach you more than that here. 2 times square root gives you what? 4th root. Correct? 8th root means what? 3 times square root. Father, don't do 15 times minus 1 etc. That's unnecessary one. We'll be getting the same answer there also. Can I proceed? So it is equal to what is the 4th root of 1.4237? What's the number? 1 plus r is equal to 1.0933. 1.0933. 1 plus r is equal to 1.0933. R is equal to 0.0933. R is equal to 0.0933. Or how much percent? 9.33%. R is equal to 9.33%. R is equal to 9.33%. Respond, yes or no? Yeah. This is called as what? Yield. Realized yield. The bondholder ultimately with the bond coupons I earn how much yield here? 9.33%. Can I proceed or not? No. The problem is over. But I added one more part to calculate what? YTM for our comfort. Can I let's calculate the YTM so that interpretation becomes very easy. Okay, right now. Next. Step 3 or step 4? Step 4. Calculation of YTM using shortcut formula. Calculation of YTM using shortcut formula. Can I proceed or not? No. Tell me, what is the YTM shortcut formula? Tell me the formula. YTM is equal to interest plus amortization divided by average price. Interest plus amortization divided by average price. It is your choice. Whatever average you want, you use it. Anyhow, the number is going to be approximate only. Right or not? For that, we need not fight with each other. Can I proceed? Interest plus amortization divided by average price. Now, just to show your alertness, tell me, I bought the bond at how much rupees? 1020. They redeemed at how much rupees? 1000. What is the coupon given? My question is the yield of the bond more than the coupon 10% or less than 10% coupon? The YTM will be more than 10 or less than 10? Why you said is less than 10? Because I am buying a 1020, I get it only at what? 1000. The coupon income will be eroded by what? Capital law. My realized will be less than coupon. Yes or no? Write down. YTM is equal to, continue writing, YTM is equal to, what is interest? 100 plus 1000 minus 20, 100 plus 1000 minus 1020, 100 plus 1000 minus 1020 divided by 4. What is 1000? So what is 1000? Maturity value. What is 1020? Purchase price. I had a loss on sale, profit on sale. Loss. How much loss? 20 rupees. Is a loss of 1 year across 4 years? Across 4 years. Annualized loss. By dividing by what? 4. I get the approximate number. Yes or no? It is 100 plus 1000 minus 1020 divided by 4 whole divided by 1020 plus 1000 divided by 2. Whole divided by S plus M by 2. No, average price 1020 plus 1000 divided by 2. 1020 plus 1000 divided by 2. Please. Can I proceed above? Now, if I calculate, tell me the number I am going to get. 95 by 1010. 95 by 1010 is equal to approximately 9.41%. Is equal to approximately 9.41%. Now, the yield to maturity as per the shortcut formula is how much percentage? 9.41%. Can we calculate IRR once also? Because to get the grip. Okay, can I get the IRR or not? Now. So can I start with, because IRR start with a guess rate. Okay. Can I guess 7% as IRR? Can I guess 18% IRR? No. There's something nearer to what? 9.41%. So let's guess as 9% or 10% and then do it. Can I proceed or not? No. Write down. Next. Step 4 or step 5? Step 5. Calculation of IRR of the bond cash flow. Calculation of IRR of the bond cash flow. These steps are not required in the question. I only included the YTM for this problem to get the grip. Calculation of IRR of the bond cash flow. Okay. Have the following columns. Year, cash flow, present value factor at what percent? 9%. Discounted cash flow. Year cash flow, PVF at 9%, discounted cash flow. Always for IRR, leave sufficient space on the right because I have to find out one more discount rate if this is not satisfying, right or not? So, just don't use the full page, up to half a page, have this. Can I proceed? Now, year 1 to 4 and then 4. 1 to 4, 4. What's the cash flow you get from the bond? 100 every year coupon for 4 years and 1000 redemption. 100 coupon, 1000 redemption. Annuity factor 9% 4 years calculated. 1 divided by 1.09 is equal to 4 times plus grand total. 1 divided by 1.09 is equal to 4 times plus grand total. What's the number? 3.2397. The total is 3.2397. 1 divided by 1.09 is equal to 4 times, leave as it is, tell me the percent value factor, 0.7084. 0.7084. Always class can be understood only when you involve yourself in the calculations. Can I proceed or not? Now, all of you calculate and write, please. Tell me, what is 100 into 3.2397? Don't use calculator. 323.97. 323.97. 1000 into 0.7084 gives you what? 708.40. 708.40. If you total, I'll get how much? 1032.37. Total is 1032.37. Answer is 9% IRR, not IRR. Why it is not IRR? For me to call it as IRR, this total should have been how much? 1020. Price of the bond. Is or no? It is not 1020, it is what? 1032. That means these numbers, discounted cash flow should be made as 1020 or not. In that case, the DCF should be increase or decrease or decrease. To decrease the discounted cash flow, the factor should be reduced. To reduce the factor, interest should be increased. Can we check a 10% or not? Yes. Right on. Present value factor 10%. Because after 9, the next percentage is 10%. Present value factor 10%. Okay. So tell me, what annuity factor for 10% 4 years? 1 divided by 1.10 is equal to 4 times. Grand total, what's the number here? 3.1699. 3.1699. Fourth year present value factor is 0.6830. 0.6830. 0.6830. Now, 100 into 3.1699 gives you what? 316.99. 316.99. And then 1000 into 0.6830 gives you what? 683. That is 317 we can have. 316.9 is nothing but 317. 683 plus 317 gives you what? Good morning, friends. Good morning, friends. You should not have allowed me to do this calculation, right or not? When they say 10%, you say, so the value should be par value. The coupon given is how much? 10%. My YTM also will be 10% only when I have no capital gain, no capital loss. Yes or no? Sir, for me to earn an yield same as coupon, I should purchase a bond at what value? Par value. At 10% YTM, the bond value should be what? Par value. Yeah, right or not? Why did you allow me to calculate? Tell me first. Sleeping, huh? Yeah. Okay, now, because this is alertness. Okay, I was also hoping anybody will be raising their hand and what? Stopping me. Nobody. 100% sleeping. I don't know. Very simple. This is what we call as what? Agility in doing any sum here. When I say 10%, you should say coupon also 10%. You want a yield of what? 10%. Then the bond should be trading at what? Par. Only when the bond is trading at par and redeemed at par, my coupon can be what? Yield. If the bond is trading at the price other than par, then the yield will be either more than coupon or less than coupon. Based on whether I make a capital gain or capital loss. Everybody, are you following or not? But still, why I did is to confirm what I am saying is true. Okay. So what is that here? 1000 rupees is a bond value. Right or not? Now, tell me, is 10% IRR? Because I am not buying at the par value, I am buying at what? 1020. So it is lying between these two numbers, right or not? Now, let's continue further. Up to the have you copied or not? Now, same step you continue. YTM. Okay, I will do it here. Okay. Okay. 9%. Right here, 9%. What is 9% bond value? 1032.37. 10%. What is the bond value? 1000. Bond value is 1000. But my bond price is not 1032, nor it is par. It is trading at 1020. What should be the yield? In 1020, what should be the yield? Can I proceed above? Now, please tell me. When I move by 1% upwards, when the yield goes up by 1%, 9 to 10, bond price crashes down by how much rupees? 32.37. The bond price drops by 32.37. It drops by 32.37. Do I want it to drop by 32.37 or 20? 20. I want the bond price to drop by 20. The price should drop by 20. What should be the percentage? 20 by 32.37 into 1. Give me how much percentage you going to have here? Tell me the number. 0.62 percentage. Am I right or not? What are you saying? 20 by 32.37 into 1. What's the number? Oh, sorry. I am wrong, yeah. Okay, I was sleeping. 12.37 now? Okay, sorry. 12.37. I made a mistake. 12.37 divided by what? 32.371. Tell me the percentage here. 0.38 percentage. 0.38 percentage. Now, right? YTM is equal to 9 percentage plus what? 0.38 percentage. YTM is equal to 9 percentage plus 0.38 percentage equals how much percentage? 9.38 percentage. YTM is equal to 9.38 percentage. 9.38 percentage. Now, can I proceed or not? Now, I will write 4 percentages. You tell me the meaning of all the 4 to get the grip. Okay. Have you found the YTM 9.38 or not? No. I am writing the above percentage. 10 percentage, 9.38 percentage, 9 percentage, 9.33 percentage are all the rates you have come across in this problem till now. Yes or no? No. Settle down. Are you listening? Tell me. 10 percentage, 9.38 percentage, 9 percentage, 9.33 percentage. 4 numbers I have written. Written not. Tell me. What is 10 percentage? The bond gives its bondholder every year a coupon of how much percent? 10 percentage. This is nothing but what? Coupon is used to calculate the cash flow. I may buy the bond at 5,000 rupees or 500 rupees. Still they pay me what? 10% on the face value. This is called as what? The bond coupon. This is called as par yield. This is called as what yield here? Par yield. Everybody yes or no? Now, next. Now, but did I earn 10% from the bond? No. The bond gave me how much percent? 9.38%. The question is, sir, bond is giving me 10% coupon. How I earn only how much? 9.38. Tell me why I earn less than coupon here? Because I purchased at 1020 and they give me money back only at what? 1000. The coupon stands eroded through what? The capital loss. So this 9.38 is the actual return I earn from the bond called as what? YTM. Ennappa return or so the bond gives a coupon of 10%, but bond gives a return of only how much? 9.38 because they give coupon and I lose what? Capital loss. I earn only 9.38. Yes or no? Now, the money which I get, the coupons and all which I get, I invest back at what percent? 9%. This 9% I call as what? Reinvestment rate. I call as what rate? Reinvestment rate. The bond is giving me a return of how much percent? 9.38. I am able to invest back only at how much? 9%. I am investing at the same yield, less than yield to maturity, less than yield to maturity. That means ultimately I realize only how much here? 9.33, which we call as realized yield to maturity. Everybody having the clarity or not? Like this, one should differentiate the various interest percentage with the bond is giving to its bond holder. Right or not? Now, write down note. Write down note. The bond gives a coupon of how much percent? 10%. The bond gives a coupon of 10%. But the return it gives its bondholder is only but the return it gives the bondholder is only how much percent? 9.38%. Bracket la YTM. But the return it gives its bondholder is only 9.38 percentage. In bracket right? YTM. Because the coupon earnings is eroded by the amortized capital loss. Because the coupon earnings is eroded by the amortized capital loss. The coupon earnings is eroded by the amortized capital loss. Everybody following not? This you can call as point number 1. You call this as point number 1, what you written. Point number 2. The bond gives the bondholder an yield of the bond gives its bondholder an yield of the bond gives its bondholder an yield of how much percent? 9.38%. The bond gives its bondholder an yield of 9.38%. But ultimately, the bondholder realizes only how much percentage? 9.33 percentage. But ultimately, the bondholder realizes only 9.33 percentage because he reinvests the bond cash flows at 9%. A rate less than YTM. He reinvests the bond cash flows at 9%, a rate less than YTM. A rate less than yield to maturity. With this, we have completed this concept called as realized yield to maturity. Everybody, are you comfortable or not? No. Take question number 9. The following data is available for a bond. Please settle down. The following data is available for a bond. Face value 1000 rupees. Coupon interest 16% payable annually. Years to maturity 6 years. Redemption value 1000. Current market price 964 rupees and 7 paise. What is the yield to maturity, duration and volatility of a bond? That's a question. Okay. Now, in this question, they asked you to calculate 3 numbers. How many numbers? 3 numbers. Can you name the 3 numbers? YTM, duration, volatility. Out of the 3, what you already know? Let us first calculate the YTM and then see how the duration and volatility is calculated. Duration, what is the meaning? I'll to some extent explain now. More you can understand during immunization. Volatility can be understood. There's a formula derivation for the volatility, in which a duration derivation also comes, which I'll be discussing at the end of the session. Because now I don't want to go into the derivation of a given formula and then change the track. I think you are following not. There is now using a differential calculus, one can have a formula for the volatility also. In that formula derivation, in between the number duration also comes. Okay, all those formula derivation technical part I'll discuss as an appendix to this chapter at the end of this chapter, not now. Can I say? But now we'll learn how to calculate a volatility, duration, what the meaning of a volatility and duration. Everything we'll be discussing now. Can I proceed or not? Now. In this question number 9, we already know how to calculate YTM or not? No. Answer my question. Is YTM 16%? Answer my question. Answer one. Is YTM 16%? Why you days it is not 16%? Because the bond is not trading at par. It's trading how much a base? 964.07. If you buy this bond, will you earn 16? More than less than? Because I'm also having what? Capital gains out of it. This is all following and all. Let's start calculating the YTM. We can calculate YTM. How many methods here? 2 methods. Formula, IR. Can you start? Let's start the step together. Write down. Question number 9. Okay. Step 1, calculation of YTM. Step 1, calculation of YTM. Underline that. Step 1, calculation of YTM, underline that. That right? Approximate formula is equal to YTM approximate formula is equal to YTM approximate formula is equal to what's the formula? Interest plus amortization. Interest plus amortization divided by 0.6 into S plus 0.4 into M. Don't ask me, I am very fair person giving equal chance to both the formula, written order. So I did the last problem using average, here use the weighted average, that's all. 0.6 into S plus 0.4 into M. Now, tell me what is the interest percentage? 16%. On what face value? 1000. Tell me what is the interest here? 160 plus. 160 plus, take the calculator. What is 1000 minus 964.07? Tell me the number here. 35.93 divided by 6. Now 35.93 is a capital gain over 6 years now. 160 plus 35.93 by 6 whole divided by 0.6 into 964.07. That is 0.6 into subscription price plus 0.4 into 1000. 0.6 into 964.07 plus 0.4 into 1000. Respond. Tell me what is the number you are going to get? Somebody do and tell me. 160 plus 35.93 divided by 6 whole divided by 0.6 into 964.07 plus 0.4 into 1000. Please somebody do and tell me what the number you are going to get? 978. Numbers, how much percentage? 166 divided by 978.44. 166 divided by 978.44. What's the number here? 16.97%. 16.97%. Approximately YTM is how much percent? 16.97%. For IRR, can I guess as 11%? Can I guess as 25%? I can just start my guess as how much percent? 17%. Let's start with that. Here, even cash flow, PVF at 17%. Cash flow, discounted cash flow. Here events, cash flows, present value at 17% is PV factor and discounted cash flow. Okay, can we start or not? Now, tell me years what? 1 to 6 coupon. 1 to 6 I get coupon. What is the cash flow? 160. 1 to 6 coupon, cash flow 160. PV factor, annuity factor, annuity factor. Calculator 1 divided by 1.17 is equal to 6 times grand total. 1 divided by 1.17 is equal to 6 times grand total. Tell me what's the number I am going to get? 3.5892. Number is 3.5892. 3.5892. Tell me what is the discounted cash flow? 574.27. 574.27. Sixth year, I am going to have a redemption or maturity. Sixth year, the event is maturity. What is the amount I am going to get? 1000. Amount that we obtained is 1000. PV factor 1 divided by 1.17 is equal to 6 times in the calculator. Tell me the present value factor. 0.3898. 1000 into 0.3898 gives you 389.80. 389.80. If I total, I get 964.07. The total is 964.07. Is 17% IRR or not? Yes, exactly 17% is what? IRR. It gives you the bond price directly. Yes or no? So the YTM is how much percent? 17%. Right? YTM is equal to 17%. YTM is equal to 17%. Yield to maturity is 17%. Okay. Shall I proceed or not? Now, we are going to calculate what? Duration. Follow the procedure and I give you time to copy it. Very simple. But you should also involve yourself in the working while do the procedure. Can we start or not? Now, First of all, those who have understood up to YTM calculation now, raise your hand. Are you with me or not? Now let's start with the duration calculation. Can you switch on the AC? Yeah? After 5 minutes. Okay. Okay. After I complete duration, we'll have the discussion once again. Can I proceed? Now. First. Okay. Don't talk. First, what I do is, I write the bond cash flows. And then discount it using YTM. Discount it using what? YTM. What I will get is what? Bond price. Correct. What is the bond cash flow? 160, 160, 160, 160, 160, 160. How many years here? 6 years. And then 1000 in that of the 6th year. If I discounted YTM how much percent? 17%. The discounted cash flow will be how much? 864.04, 964.07. Because when I discount the bond cash flows at YTM, I should be obviously getting the bond value or bond price. Yes or no? Let me do that first. Can I proceed? Now, everybody participate. Okay. Year 1, 2, 3, 4, 5, 6. Tell me the cash flows. 160, 160, 160, 160, 160, 1000, 160. Right. Present value factor is 17%. What is so sacred about 17%? It is going to be what? YTM. We have calculated just now, no? Because to calculate duration, one should first calculate what? YTM. I have discounted what percent? 17%. Take the calculator. All of you participate, please. Don't watch. Do. 1 divided by 1.17 is equal to chorus. What's the answer? 0.8547 is equal to 6244 is equal to 5337 is equal to these are all the present value factors are 17% for 6 years. Or not? Now, I find discounted cash flow 160 into 0.8547, 2 decimal sound off. Tell me what is 160 into 0.8547? Everybody. What's the number? 136.75. 160 into 0.7305. Tell me the number. 116.88. 160 into 0.6244. What's the number? 99.90. 160 into 0.5347. What's the number? 85.39. 160 into 0.457. What's the number? 72.98. 1160 into 0.3. 452.17. Some number. 457.17. Now, the total should be how much? 964.07. 1 or 2 decimal here and there, leave it. Okay, it's going to be 964.07 because if I discount the cash flows at YTM, I will obviously get what? Bond price. Because with bond price only the cash flows are compared to find out YTM. Yes or no? It should be obviously 964.07. Respond. Yes or no? No. See, I put into the bond market how much principal? 964.07. In that, how much principal is recovered in the first year? 135.75. Yes or no? See, always understand that a cash flow is there. If I multiply a cash flow with the present value factor, I take out the principal portion of the cash flow. Are you following? The balance is what? The interest portion. I'll just tell you one example. See. NPVA is only that concept. Okay, we'll discuss on IPCC, but still I'll tell you like this. Now, present value factor at 10% 1 year. At how much percent? 10% 1 year is equal to 0.9091. This understood or not? That means 1 rupee received at the end of the first year is today worth how much? 0.9091 is one way of understanding it. Right or not? Now, let me take a project for example. Year cash flow, present value factor at 10%, discounted cash flow. Okay, just to understand the meaning of PV factor. Okay, let's take a 3-year project, year 1, 2 and then 3. It gives you suppose 1 lakh. 3 lakhs and then 2 lakhs. Let me take an example. P factor is how much? 0.9091, 0.8264, 0.7513. Multiply, what is the number here? 90,910. 3 lakhs into 0.8264 gives how much a base here? Tell me. One person 2 lakhs. 2 lakh 40. 7,000. 920, yeah? Okay. Third is how much? 1 lakh. One person 1 lakh. 50. 50,260. Tell me the discounted cash inflow. Discounted cash inflow is equal to, tell me the number here. 4 lakhs. One person 4 lakhs. 89,093. This on the cash inflow. No, don't fight for 3 rupees and all. I will give you. Can I say it now? But only to one. You cannot give to the entire class. Can I say it? So 4,89,000. It becomes material. Yeah. Can I say it? So 4,89,090 rupees. It discounted cash inflow. Now, useful discussion because it will help you to understand share valuation later, the meaning of NPV. Don't think I am sidetracking the issue because I just take this as an opportunity to discuss one small concept. Okay. Now, see, I have a project. I invest money in a project. How many years project? 3 years project. It gives me 1 lakh in the first year, 3 lakhs in the second year, 2 lakhs in what? Third year. And this is a discounted inflow. Yes or no? No. To start a project, I should invest money or not? Suppose the initial investment is 4 lakhs. What is the initial investment? How much the base? It's going to be 4 lakhs. Then I call it as what? Discounted cash outflow. Then I call NPV as how much here? 89,090 is a mini capital budgeting problem. Right or not? Now, I invested 4 lakhs in a project. It gave me so much money. I discounted it. I got how much? 89,090 as a NPV. Respond. Yes or no? Let's understand. Really, what is this 89,089? Then we'll be understanding the concept of wealth also properly. Can I say? See, this 4 lakhs, if I want to invest, I require money or not? Always, introduction class of the SFM, bond introduction, everywhere I said, first there is a funding, and there is a investment, then there is a return, and fund provider is return back. Yes or no? No. See, I have to raise this 4 lakhs. Person giving me this 4 lakhs will expect a return from me or not? Bondholder says, particularly I want so much YTM. Shareholders is going to be what? Silent but expects. I will find out what I am saying. So the fund provider asks me some return or not? Now, that is what we call as cost of capital. Let's say it is 10%. How much cost of capital? 10%. I get this money at a cost of 10%. Are you following not? This money can be 4 lakhs can be raised at an YTM of how much percent? 10% to the investor, or the company can issue shares at an yield of how much percent? 10%, something here. The money is raised at 10% cost. Are you following or not? Now, what it means is 0.9091. What does it mean here? 0.9091. 1 rupee received at the end of the first year is having 2 parts, principal and then what? Interest. The principal portion of 1 rupee is 0.9091. The interest is 1 minus 0.9091. Tell me what the interest portion here? 0.0909 is the interest. One should understand like this, 1 rupee. Yes or no? Very simple. Today, suppose year 0, I borrow 90 paise. I borrow how much paise here? 90 paise. 0.909, I just borrow. At the end of the first year, I should repay how much base? 1 rupee. Because 90 paise for principal and 9 paise for what? Interest. Yes or no? So, if I get 1 rupee at the end of the first year, suppose the project gives me what? 1 rupee at the end of the first year, what happens is 90 paise goes to recover the outflow. Yes or no? Principal, and balance 10% goes for what? Interest. Ennappa, right or not? Like that. 1 rupee 90 paise can be attributed to principal, means in 1 lakh rupee 90,910 can go to what? Repayment principal, and balance is for the interest portion. Yes or no? That means the project cash flow of 1 lakh, 3 lakh, 2 lakhs is capable of repaying how much principal? 4,89,090 principal after servicing what? 10% cost of capital. Yes or no? In the cash flow, I take out the cost of capital servicing separately. I take what? 10% servicing separately. The balance 4,89,090 is available to service my fund provider's principal. Yes or no? But he gave me only how much principal? 4 lakh. That means 89,090 I have earned surplus over and above the cost of capital of 10% and the principal of 4 lakh. Everybody following or not? This is what we call as what? Wealth maximization. Very simple, yeah. Company gets 4 lakhs. Company got what? Gets 4 lakhs. Invest also what? 4 lakhs. But ultimately, from the investment, it will have earned more return. You know, IRR is not 10. IRR should be what? More than 10. If IRR is 10, this number should have been 4 lakh. Yes or no? But I earn what? More. Suppose, example, IRR is 12%. How much percentage? 12%. I get 4 lakhs. I invest what? 4 lakhs. From that, I earn how much percent? 12%. In which I give what? 10% back. I give what? 4 lakhs back. I make a margin of 2%. That creates a positive NPV. Are you following or not? NPV concept what? NPV. Are you following on? Now, in this, I'll come back to the discussion once again during dividend policy, Modigliani-Miller approach or a rights issue. Everywhere, one should know how the NPV comes from so that valuation can be what? Very much possible. This 89,000 does not belong to bondholder. Belongs only to what? Shareholder. Because the shareholder only enjoys variable return, not the bondholder. Yes or no? Correct? Now, suppose I get this from the bondholder 10% YTM, he get only what? 4 lakhs and his 10% service. The entire balance money goes to what? Shareholder to increase the wealth of the shareholder. Are you following or not? In this, what I want to tell you is, when I multiply a number with the present value factor, that means from the cash flow, I take out their expected yield and the balance left for their what? Principal recovery. Now, that is what I am trying to do here also. See, come to this particular part. See, 160 rupees I get, yes or no? He says, entire 160 can attribute to the price recovery of 964. Because he is giving this 964 not only for 0% interest, he wants how much percent interest? 17% yield, yes or no? Correct? He wants how much percent yield here? 17% yield. Are you following what I am saying? In that case, when I get 160, in which 0.8547 of that amount only can be attributed to what? Principal recovery, and balance should be attributed to what? Servicing is expectation of yield to maturity. Everybody, yes or no? In that case, what happens is, out of 964.07, in the first year, his principal portion stands recovered. How much rupees? 136.75. Do you understand this? 136.75 is attributable to principal portion or not? Yes. Because any number, if you multiply with what? PV factor, the PV factor takes out what? The principal portion and leaves out the interest, because you should not be serviced only 964. You should also be serviced what? 17% interest on the outstanding amount. Please respond yes or no. In that case, what gets serviced? How much? 136.75. That means, in the first year, the proportion of principal recovered is 136.75 divided by what? 964.07. What the proportion recovered? 0.1418. Or 14.18% of his investment stands recovered in what? First year. Yes or no? Now, second year, how much he recovers? 116.88. Out of how much? 964.07. In that case, how much principal stands recorded in second year? 0.1212. Proportion stands recorded in what? Second year. Third year, he recovers 99.9. Out of what? 964.07. What principal stands recorded in the end of the third year? 0.1036. Fourth year, he gets 85.39 out of what? 964.07. How much proportion stands recovered by the fourth year is going to be 0.0886. Fifth year, he recovers 72.98 out of 964.07. What proportion is recorded in the fifth year? 0.0758. 452.17 divided by what? 964.07. What proportion gets recorded in the last year? 0.4690. Don't total. The total should be what? 1. Because the entire amount stands recovered in the last year. Everybody, yes or no? Now, very simple. If he expected 16%, if he expected what? 16%, this number would have been what? 1000. Since he expected 17%, the 16% coupon, understand the value once again. He expected how much percent? 17%. Is 16% coupon enough to recover his 17% expectation on the full par value? Did I understand the question? See, you want 17%, yeah. I give you 16%. Right or not? You want how much percent? 17%. I give you only what? 16%. My 16% coupon and 1000 par value, is it sufficient to recover investment of 1000? Because you don't want 16%, you want how much percent? 17%. That means my PE factor is going to be what? Less. It requires lesser principal, yes or no? That means a 16% coupon paying bond is able to recover only 964.07% rupees of what? Par value. If a bond holder expects 17%, are you following? If we expect more, then I can recover only one. Less principal for you. Are you following what I'm saying? And you say, I will pay only 964 for this bond because I want 17%. Are you following? The issue now, suppose you expect only 15%. How much percentage? 15%. The bond gives a 16% coupon or not? Yes or no? In that case, what happens is, after recovering your 15% expectation, I not only will be having par value left, I will be having what? Something more than that, something similar to positive NPV, yes or no? That we call as capital gain in the bond portfolio. Are you following what I am saying? So in that case, after recovering my expectation, what is left is available for what? Bond price. If expectation is same as what? Coupon, what is left will be equal to the par value. Yes or no? If my expectation is more than coupon, what will be left is what? Less than the par value. That's the price I am willing to pay for the bond. Everybody following order. And here I paid how much price for the bond? 964. Is the entire 964 required in first year? No. First year how much proportion required? 0.1418. Second year 0.1212 and so on. This is a proportion of recovery. Respond. Are you following? Now, let's go for the last discussion. I put into the market how much rupees? 964.07. Somebody asked me, for how many years this money is blocked in the market? Very simple. I give you 100 rupees. You don't look at all for me for 6 years. After 6 years, you come and give me what? Some money. My money is with you for how many years? 6 years. That means my money is blocked with you for how many years here? 6 years. Like that. I put how much rupees in the market? 964.07. This money is blocked in the market for how many years? Wrong. Because 14% of this money is blocked only for 1 year. And another 12% of the money is blocked only for what? 2 years. And if you want, you can say this 46.9% of the money is only blocked for what? 6 years. Yes or no? That means duration is the number of years for which the money is what? Blocked in the bond. Yes or no? That means this is weight, this is duration. This is what? Weight, this is what? Duration. 0.1418. 40% of the money, the duration how many years? 1 year. For another 12% duration, how many years? 2 years, and so on. If I ask you what the duration of my entire fund, this 1 year or 6 years average. Is what? Average. Simple weighted average? Weighted average. But the weights are what? The proportions. Are you following? Right or not? In that case, tell me what the duration is? 0.1418 into 1. Tell me 0.1212 into 2. And another thing is for 3 years, what is the money block? 10%, 0.1036 into 3. For 4 years, what is the money block? 0.0886 into 4, 0.0758 into 5, and 0.4690 into 6. If I add it, I can say on an average, my money blocked in the market is for how many years here? 4.2424 years. It is wrong to say the money is blocked for what? 6 years, because they give you some portion of the principal here also, right or not? And wrong to say blocked only for 1 year, because there are only 40 recorded in what? First year. I don't say it is blocked in extremes. On an average, the money blocked in the bond is how many years here? 4.2424 years. This is what we call as duration of a bond. Are you following? Right or not? Now, tell me first. Procedure, let's tell. Duration of a bond. To calculate duration, first what should you calculate? First you calculate what? YTM. That is his requirement. So first you have to calculate what? YTM. Once we calculate YTM, then we calculate the duration. Tell me what you'll do. I write the years, I write the bond cash flows, discounted using YTM, I get the discounted cash flow. The total of discounted cash flow should be equal to what? Price of the bond. Yes or no? Now, the discounted cash flow every year to the bond price, I find out the proportion. That proportion multiplied by what? Years. What I get is what? Weighted years or weighted duration. The total is called as duration of the bond. Are you following? Okay, now, one way of understanding duration is my money of 964.07 is blocked in the market for how many years? On average 4.2424 years. Because 46% of the money is blocked for 6 years. 40% is blocked only for what? 1 year. I cannot say the entire money is blocked for 6 years. On an average, my money blocked inside the bond market is how many years here? 4.2424 years is the straightforward way of understanding the duration. Point number 1, accept or not? But duration is to be understood in 2 more ways. How many ways here? 2 more ways. Second point I say is, when I buy a bond, when I buy this bond, I should not keep this bond for 6 years. I should keep this bond only for how many years? 2.2424 years. To protect my 17% yield is the duration. Another meaning of duration is what? Is the optimum holding period. I buy this bond is how many years life? 6 years. But I will not keep it for 6 years. I sell the bond in the bond market how many years here? 4.2424 years. To protect my 17% yield. There is also another meaning of what? Duration. Why and all? Don't ask me the question. That is what is called as immunization strategy later. Yes or no? In immunization strategy they say hold the bond for what? Duration. Don't hold the bond for maturity. We'll be proving through numbers. Why should I hold for duration? Why I should not hold for what? Maturity. So duration can be called as optimum holding period of the bond. Don't ask me too many questions. We'll be discussing in the next class. Are you following? Now, tell me what is duration? 4.2424 years. On an average, my money blocked in the bond market is how many years? 4.2424 years is one way of understanding it. Yes or no? The second way of understanding it, duration is what period? Optimum holding period for the bond. This bond may have 6 years life, but I would like to give the bond only for what? 4 years and sell in the 4.2424 years and sell in the open market. Why? Don't ask me the question. We'll discuss in what? Immunization strategy later. Everybody following or not? Now, third is duration. This may be very, I can say, a very crude way of saying duration is a working note for volatility. What is duration here? Working note for volatility. Volatility as a derivation has got what? A derivation using differential calculus. In the derivation, in the mid what? Duration comes. We'll discuss at the end of the chapter. Are you following or not? Now, somebody asks you, what is duration? Tell me how many ways you say? What are 3 ways you say? First one is what? It is the average period for which my money is blocked in the bond market. Other way of saying is what? I should hold the bond only for duration. Is the optimum holding period to protect my yield of 17%. The third way of saying is what? Duration is a working note for volatility. Is a working note for what? Volatility. Don't laugh here. We'll know the importance of the working note when we derive the volatility formula in some subsequent class. Are you following or not? So this is regarding the concept of duration. Yes or no? Exam, they don't ask interview and all about duration. What is how to calculate? You know how to calculate or not? No. Tell me what is duration, how to calculate? Tell me the step. First calculate what? Everybody participate. 1, 2, 3 start. Tell me what to do first. Tell me. Calculate what? YTM. Then write the bond cash flows. Discount using YTM. You find out discounted cash flow. The total should be equal to price. Then find out proportion. What is proportion? Discounted cash flow to price. And then find out year into proportion. The total is called as duration. Duration can be understood how many ways? 3 ways. One is what? Average money blocked in the bond market. Number 2 is what? Optimum holding period. Third is a working note for volatility. Respond. Are you following or not? This one should be understanding the duration calculation. Can I proceed? Now. One more thing before I give you time to copy. You are then up to YTM calculation now. Now see. 6 years bond you can calculate. Suppose I have a bond for 12 years. This calculation becomes very big. Now I have to write 12-year cash flow, 12-year present value factor, discounted cash flow, proportion, multiply. Suppose the bond is 20 years, become much more longer or not? So there is a formula for calculating this duration, a shortcut formula for calculating the duration. Let me put the formula now. Duration of a bond, formula is 1 plus y by y minus 1 plus y plus t into c minus y divided by c into 1 plus y power t minus 1. Don't shout here. This is a shortcut formula for calculating what? Duration. See, y means yield to maturity. Y means what? Yield to maturity. T means term of the bond. How many years? 6 years. C means coupon rate. The word C means what? Coupon rate. That's the formula for duration. Now, please look at the formula. By heart it. We cannot take bit and all to the examination. Okay. By heart it. Then we can just start doing the substitution. Nothing great. Just simply substitute to find out the answer. Just go through the formula first. Can you proceed? Tell me the formula for duration, please. All of, wait. What the first term? 1 plus y divided by y minus 1 plus y plus t into c minus y divided by c into is the formula for calculating the duration. Everybody following or not? No. It is very simple only. If you just by heart, that's a one-time issue. Can I or not? Is how one should be calculating the duration. Because suppose the bond is semi-annual. Bond is what? Semi-annual. The 6 years bond will be having 12 periods or not? They will be having 12 rows to discount. Yeah? Quarterly means what? Same 6 will be having 24 cash flows. So it becomes very difficult. But one can easily substitute in this formula to calculate the duration of a bond. And I'll say why this formula is very essential also. Okay, I'll tell you. In one of the examination, a 5 marks question has been asked, where they gave you the duration. They gave you what? Duration. They gave you the coupon. They gave you the coupon and they gave you the bond years and asked you to find out YTM. Understand my question or not? That is, they gave you everything. They asked you to find out what? Yield to maturity. In that case, I cannot use a YTM normal way of calculating because we don't know the face value, we don't know the subsequent price, nothing given here. They say a bond having duration of 5 years, carrying a coupon of 10% and having a maturity of 6 years. Calculate YTM means I should necessarily calculate YTM only using what? This duration formula, right or not? And in some problems, they may not give you any rupee details. They may give you YTM, coupon rate, term. Ask you to find out what? Duration. In that case, you cannot use what? The table approach because we don't know what the face value, what the dimension, what the price, nothing is known. Are you following or not? In that case, this formula also will be sometimes useful for our calculation purpose. Enough for it or not? So this is a formula for calculating the duration. Now, please don't get irritated. Tell me what the duration formula? 1 plus y by y minus 1 plus y plus t into c minus y divided by c into 1 plus y power t minus 1 plus y. Where c is what? Coupon rate, y is what? Yield to maturity, t is what? Term of the bond and d is the duration. Can I proceed or not? Now, I'll substitute the numbers. Very simple. Y is 17%, yes or no? 1 plus 17% is 1.17 divided by what is y? 0.17 plus what is 1 plus y? 1.17 plus t into 6 years into c is what? 16%, y is what? 17% divided by c is what? 16% into 1 plus y power t means what? 1.17 power 6 minus 1 plus 0.17. You'll be getting the same number 4.2424 years as what? Duration is a way of calculating the duration. Up to this, are you following or not? Now, one more part only left over. That's calculation of what? Volatility. Before that, tell me. Duration has got how many ways of calculating? 2 ways. One is a logical approach, another is what? Formula based approach. What the logical approach? Calculate YTM, discount the bond cash flows using YTM, find out the discounted cash flow which should total to bond price, find out proportion of discounted cash flow to bond price, multiply the proportion by years, the total gives you duration. Yes or no? Now, the second way of calculating duration is what? Formula. What is the formula? 1 plus y by y minus 1 plus y plus t into c minus y divided by c into 1 plus y power t minus 1 plus y is the duration formula, right or not? Now, duration can be understood in 3 ways. It is the period for which my money is on an average block in the bond market. It is the optimum bond holding period to protect my 17% yield, which we'll discuss in what? Immunization later. And third is what? Is a working note for volatility calculation. Everybody following not? This is what I can tell at present about the duration. More about duration you can understand during the immunization strategy discussion. Everybody following or not? Now, up to this you copy before I proceed to the next stage. Now, what the first step you have written here? Step 1 is what? Calculation of YTM. Write down step 2. Calculation of duration. Step 2. Calculation of duration. Step 2. Calculation of duration. Finish copying up to column 2. I am not finished here. Up to column 2 finish copying. No. Stop talking. Those not copy, raise your hand. You are taking very long duration, yeah? Copy quickly. Stop talking, please. Shh. Stop talking. Can I proceed on? No. Those not copy, raise your hand. Okay. Now, alternatively, duration can be calculated, same step you continue. Alternatively, duration can be calculated using the following formula. Alternatively, duration can be calculated using the following formula. Duration can be calculated using the following formula. Using the following formula. Finish copying? Shortcut formula, duration should be short. Okay, answer may be same, but the real duration should be short. 4.2424 years. Finish writing, huh? Stop talking. Please. Shall I proceed? Those who are not copy, raise your hand. Okay. Write down notes. Write down notes. Point number 1. I'll first give the definition as given by everybody for duration. Nobody says this is duration. Definition itself is calculation only. They call as what? Definition. Nobody pinpoints the meaning of duration because it cannot be given any logical meaning together. Can I proceed? Write down first. Duration of a bond is, write notes. Point number 1. Duration of a bond is its weighted duration. Duration of a bond is its weighted duration. Duration of a bond is its weighted duration, where the weights are, duration of a bond is its weighted duration, where the weights are, the proportion of, where the weights are, the proportion of the bonds discounted cash flows, where the weights are the proportion of the bonds discounted cash flows to the bond price, where the weights are the proportion of the bonds discounted cash flows to the bond price, discounted at, fill in the blanks, discounted at what? Yield to maturity. Discounted at yield to maturity. Discounted at yield to maturity. Believe me, nobody says duration, average, holding period, etc. These are all uses only. Nobody is able to pinpoint what is the duration. This is one of the working note in the first derivative of a bond price differentiation. Are you following not? So they call duration only as a mathematical, what I say, computation process they define. They are not defined as a logical number. Are you following not? Nobody can say what this 4.2424 year means. That's how duration has been defined. Like book like Febosi and all, I said no, fixed income securities, all of them define duration only this way. Can I proceed or not? Next. Point number 2. Point number 2. Duration can be understood. Duration can be understood in the following 3 ways. Duration can be understood in the following 3 ways. In the following 3 ways. A. It is the average period for which money is blocked in the bond instrument. It is the average period for which money is blocked in the bond instrument. It is the average period for which money is blocked in the bond instrument. Money is blocked in the bond instrument. Tell me, my 960 rupees is blocked for how many years? 6 years? No. On an average 4.2462 because some money gets recorded even in first, second, third, fourth year. Right or not? Next. B. Point B. It is an optimum holding period for the bond. It is an optimum holding period for the bond. It is an optimum holding period for the bond to protect the yield. It is an optimum holding period for the bond to protect the yield. It is an optimum holding period for the bond to protect the yield. Bracket right, discussed during, will be discussed during what? Immunization. When you revise now, you can just go there and come back. Okay, so discuss during immunization. Discuss during immunization. Bracket close. Discuss during immunization. Bond immunization we call now, discuss during immunization. Point C. It is a working note for calculating volatility. It is a working note for calculating volatility. It is a working note for calculating volatility. With this, we complete our discussion regarding the concept called as duration. Okay. Now, volatility, very small. 1 minute you can just calculate it and see what is the meaning of that. Okay. Now, next is what? Volatility. No need to copy, participate. Volatility of a bond is equal to duration divided by 1 plus YTM. What volatility? Duration divided by 1 plus YTM. There is a derivation for this formula. I will discuss at the end of this chapter. I don't want to detract with the main issue. Can I say? What is volatility of a bond here? Duration divided by 1 plus YTM. What it is, I will tell you after I put the number. Can I say it? Now. So, volatility of a bond is equal to what? Duration divided by 1 plus yield to maturity. Tell me what the duration you calculated, all of you. 4.2424 divided by what? 1 plus YTM 1.17. Calculated 4.2424 divided by 1.17. Tell me the number. 3.625. 3.625 what? 3.625 percentage. 3.625 percentage. Volatility is 3.626. I wrote it. 3.626 percentage is called as volatility. What it is, I'll discuss now. The derivation and more logic I will discuss at the end. Can I proceed or not? Now, volatility, tell me the formula first. What is the formula? Duration by 1 plus YTM. So, duration is one of the working note for volatility. Yes or no? Now, what is the volatility? Expressed as years, rupees, percentage, percentage. What volatility percentage? 3.626 percentage. Everybody, yes or no? Now, sir, what is this volatility? Answer my question. This bond is having a coupon of 16%. Yes or no? Market also wants 16% return. That is, market required yield is what? 16%. Bond will be trading at par. Right? Sollupa, yes or no? Bond coupon is 16% and the market also wants what? 16%. The bond will trade at par. Yes or no? Now, suppose bond coupon is 16%. I want 17%. What percent? 17%. Tell me, the bond will be trading at par, reduces. Because as the investor wants more return, he will try to reduce the price because he cannot recover the full par value. Yes or no? That means I can say that the yield to maturity, the yield and price is having an inverse relationship. Yes or no? Yield is having what? Inverse relationship. When my required yield increases, I am willing to pay only what? Less price. If my required yield decreases, I am willing to pay what? More price. If I want more return, I should reduce my investment. If I want less, I have to increase my what? Investment. So yield price relationship is inverse. Are you following? Right or not? Now, what this says is, now my yield is 17%. Right or not? Suppose I changed my yield to 18%. I want my yield to what? 18%. Today everybody wants 17%. Yeah, tomorrow RBI makes an announcement saying that what? I increase the base rate. The base interest rate is what? Increase. All over the market, people start expecting more interest or less interest or more. Because RBI increase interest rate, everybody wants more interest. Yes or no? In that case, tomorrow I want from this bond not 17, I want how much percent? 18%. That means in the market, the bond price will increase or decrease or decrease. It will decrease by 3.626%. Are you following or not? Correct? Now, suppose RBI slashes the interest rate from 17% to what? 16%. Tomorrow the bond price will increase or decrease or increase. It will increase by how much percent? 3.626%. Are you following what I am saying? So, what is 3.626%? When YTM changes by 1%. Listen here. When the YTM changes by 1%, the bond price will inversely, will what? Inversely change by 3.626%. Is the sensitivity of the price to what? YTM, we call as volatility of the bond. Are you following? Volatility is the sensitivity of what? Price. The YTM, we call as what? Volatility. The bond price, how much percent sensitive? 3.626% sensitive to the YTM change. When YTM changes by 1%, the bond price inversely changes by 3.626%. Point number 1. Accept or not? Okay, now, again, listen to my words. When YTM changes by 1%, the bond price inversely, approximately changes by 3.626%. One word I added. What is the word? Approximately. So it won't be exactly 3.626%. Only what? Approximately. Sir, how can I calculate the exact number? We'll discuss in convexity. Are you following? Everything don't think I'm postponing, because I have to only go step by step, yes or no? So again I say, what is that? Why you say volatility? When the yield maturity changes by 1%, the bond price inversely, approximately changes by 3.626%. If you want to know how much is the accurate change, I have to go for what? Convexity. And why it is changing approximately, how it can be made what? Accurately. I'll discuss mathematically during what? The convexity discussion later. Everybody following or not? Is what you call the concept of volatility of a bond. Everybody following? Now, let's check. Now, 3.626% now. That's what I'm putting. When YTMs change by 1%, the value of the bond will approximately be changed inversely by how much? 3.63 or 636%. Now, let's say, now YTM 17% now. Can YTM tomorrow become 18%? Every daily the interest rate will change. It all depends on money supply demand. How foreign exchange rate can change or not? Today dollar one rate, tomorrow dollar rate changes or not? Like that. Interest rate or market is also what? Another market called as what? The interest rate market in which daily interest rate keeps on what? Fluctuating. How share price moves up and down. Bond price also what? Moves up and down on daily basis. It's something like a share trade in the market. Are you following what I'm saying? Tomorrow morning when I open the newspaper, the interest rates are what? Increase. So now the people want to have how much YTM? 18% YTM from the bond. Tell me, will they be paying the same 964 or will be willing to pay less or more? Will they pay what? Less. How much percent less? 3.63% less. Let's see how it is going to be calculated. Can I go say? No. See, here cash flow, present value factor and different how much percent? 18% and discounted cash flow. Can I go say or not? No. From this bond, I get for 1 to 6 years, how much coupon? 160. Tell me annuity factor 18%, 6 years. Work it out. 1 divided by 1.18 is equal to 6 times. Grand total. What's the number? 3.4976. 160 into 3.4976 will be giving you how much number? 559.62. 6 years I will be getting redemption value of 1000. PV factor at 18%, 6 years. 1 divided by 1.18 is equal to 6 times. What's the number? 0.3704. What discounted cash flow? 370.40. Tell me what is the bond value? 930.02. Now, tomorrow when the investor wants 18% yield, the bond price crashes down to what? 930.02 from the present 964. Yes or no? That means the price has changed or not? Inverse rate has changed. I don't know how much is going to be changed here. See, bond price at 17% YTM is how much? 964. Bond price 18% going to be how much here? 930. Tell me the price change is how much rupees? 34.05. It dropped by 34.05. From which value? 964. Always from where you start, that should be the denominator. Yes or no? Tell me the calculation. 34.05 divided by what? 964.07. Can somebody tell me the percentage here? Percentage change is 34 by 9 into 100 gives how much percentage? 3.53. We have approximately 3.636 percentage. Right or not? That's what we call as a concept of yield to concept of volatility of a bond. Everybody following or not? Now, rumba simple, nothing rate. What is the formula for volatility? Duration per 1 plus YTM. We'll derive that later. What the meaning of volatility of 3.636%? When the yield changes by 1%, the bond price inversely approximately changes by 3.636%. That's all one should know about the volatility of the bond instrument. How to know the accurate change? Using the convexity. Everybody following or not? Now. So please copy the next step 2 or step 3 above? Step 3. Write down volatility of a bond. Step 3. Volatility of a bond. One more. Easy of a finish copying, huh? Nothing there, yeah. Volatility duration by 1 plus YTM over 4.2424 by 1.17, 3.626%. Right or not? Can I proceed? Conclusion. If YTM changed by 1%, if YTM changed by 1%, the value of the bond will approximately inversely, both it is an adjective, okay? If YTM changed by 1%, the value of the bond will approximately inversely, the value of the bond will approximately inversely change by, the value of the bond approximately inversely change by how much percent? 3.63%. The value of the bond will approximately inversely change by 3.63%. Can I proceed? Check. Assume YTM is 18%. Assume YTM is 18%. We can expect the bond value to be reduced. Assume the YTM is 18%. We can expect the bond value to be reduced. We can expect the bond value to be reduced. The bond value to be reduced. Can I start above? Now, copy the slide quickly. Finish copying, huh? Shall I proceed? Please. Write down. The volatility shows only the approximate price change. The volatility shows only approximate price change. The volatility shows only approximate price change. To know the accurate price change, we should adjust it for. To know the accurate price change, we should adjust it for. We should adjust it for convexity. To know the accurate price change, we should adjust it for convexity. We should adjust it for convexity. We'll discuss it in the later stages. Okay. Now, with this, we have completed discussion about the YTM, duration and volatility of a bond. Can I proceed? Now, we did for an annual coupon paying bond or not? Let's do one problem for a semi-annual bond. All the three calculations. Now, take the next problem. Please take question number . Take question number 10, please. Okay, can we start? Now, don't talk, please. Consider a government bond P. Instrument is bond P. Face value 1000. Stop talking, please. Coupon 8% per annum, payable semi-annually, years to maturity 4, redemption value 1000, current market price 935.36. What are the yields to maturity, durations and volatility? I think it is two bond problem, I made it one problem, so take plural out. What is the yield to maturity, duration and volatility of the bond? Okay, that's a question. Can we start or not? Now, see, everything is same as a previous sum, only changes the coupon is what? Non-annual, or it is semi-annual. That means I already said nothing great, convert everything into what? Period. Tell me, what is the coupon per period? 4%. How many periods? 8 periods. So like this you have to go for the discussion. Can we start or not? Now, let's start with the first step is to calculate what? YTM. Write down. Yes, yeah. Shall I start? Now, please. Shh. Let us first calculate the YTM. We have not yet calculated YTM for semi-annual. We did question number 6. That too, they gave you multiple choice, asked you to select whether or not. Let's calculate really YTM for semi-annual. Step 1. Please, I want everybody to participate and do it. Step 1. Calculation of YTM. Step 1. Calculation of YTM. Calculation of YTM. Underline that. Right. YTM approximate formula is equal to YTM approximate formula is equal to interest plus amortization divided by YTM approximate formula is equal to interest plus amortization divided by what into what? 0.6 into S plus 0.4 into M. 0.6 into S plus 0.4 into M. Weighted average price. Can I proceed? Now, interest I should write per annum per period. Per period. So it is 4% on 1000 face value. Right or not? What is interest here? 40. plus 40 plus, tell me amortization is 1000 minus 935.36 because I will purchase a 935, redeem at what? 1000. This is a gain for how many periods? 8 periods divided by 8. Do everything in periods please. 40 plus 1000 minus 935.36 divided by 8 periods whole divided by 0.6 into 935.36 whole divided by 0.6 into 935.36 plus 0.4 into 1000 plus 0.4 into 1000. Everybody, are you comfortable or not? Now, if you do it, please tell me what is the YTM you get. Tell me the number here. How much percentage here? 5%. YTM is equal to 5%. YTM is equal to 5%. Answer me, it is 5% per period or 10% per annum. You know, we have done everything in periods or not? YTM is 5% per period. YTM is 5% per period. Please stop talking. Can I proceed or not? No. This is what YTM? Approximate. Can we check the IRR or not? No. Write down year or period. Sorry, it's going to be period. Events, cash flow, PVF at 5%. PVF and discounted cash flow. Period, events, cash flow, present value at 5%. So we have to have factor and discounted cash flow. Factor and discounted cash flow. Shall we start now? I'll write 1 to 4 years, 1 to 8 periods, 1 to 8 periods and 8 period. 1 to 8 periods and 8 period. Events are what? Coupons, redemption, or coupons and maturity. Coupons, maturity. Cash flow. Tell me what is the cash flow every period? It's going to be 4% of 1000 is 40. Cash flow 40. 8th period, what is the cash flow? 1000. 40 and then 1000. Annuity factor 5%, 8 periods. 1 divided by 1.05 is equal to 8 times plus grand total. What is the number? 6.4632. 6.4632. 8th period, what is the factor? 0.6768. 0.6768. Discounted cash flow 40 into 6.4632, 258.53. 1000 into 0.6768, 676.80. 676.80. If you total, tell me what's the total number here? It is 935.32. 935.32. Is 5% IRR or not? Don't say, sir, 4 paise difference, leave it here. It is going to be what? IRR. As good as 935.36, we had a bond price or not? So we can say IRR is how many percent? 5%. YTM is 5% per 6 months or 10% per annum. YTM 5% per 6 months or 10% per annum. Everybody, can I proceed above? Now. YTM over. Next step is to calculate what? Duration. Right, step 2, duration. We are going to do it together. You should tell me the calculations. Right, duration. Can we start? Year. Year. Next is what? Cash flows. What? We'll do formula also. I will not disappoint you. Can I proceed? Now, first year. Next is what? Cash flow. Present value factor at 5%. Present value factor at 5%. Discounted cash flow. Proportion, duration. Year, cash flow. Present value factor at 5%. Discounted cash flow, proportion and then duration. Now, I will not write 1, 2, 3, 4 years. I write what? 0.5 years, 1 year. Now 6 months na 0.5 year na. 1 year means what? 1 year. And 1.5 years, 1.5 years, 2, 2.5, 3, 3.5, 4. You want to have 8 periods or not? That's why I write it 0.5, 1, 1.5, 2, 2.5, 3, 3.5 and then 4 years. In these periods, I will be getting the cash flows. Can I proceed? 0.5 years, I get a coupon of 40. Next I get a coupon of 40. A coupon of 40. 40, 40, 40, 40. Last period, what the coupon? 1040. 1040. I should discount at 5% because every period I have to discount. Let not take the calculator. 1 divided by 1.05. Do one right. 1 divided by 1.05 is equal to 0.9524. 1 divided by 1.05 is equal to 0.9524 is equal to 0.9070 is equal to 0.9070 is equal to 8638 is equal to 8638 is equal to 8227 8227 is equal to 7835 is equal to 7835 is equal to 7462 7462 is equal to 7107 7107 is equal to 6768. I am just telling the factors. Discounted cash flow 40 into 0.9524 gives you 38.10 38.10. 40 into 0.9070 multiply and tell me the number is 36.28. 40 into 0.8638 the answer is 34.55. 40 into 0.8277 the number is 32.91. 40 into 0.7835 it is 31.30. 31.30. Okay, make a change 31.34. Okay. 40 into 0.7462 it is 29.85. 29.85. 40 into 0.7107 is 28.43. 28.43. 1040 into 0.6768 gives you 703.87. Correct? 703.87. Am I right or not?
Correct, sir.
Okay. Total should be obviously 935 point. You may be right. You have 4 decimal extra not. 935.36 if you want you can write it. I think I wrote wrongly 31.30. It should be 31.34. It will be always almost closer to it. Okay. 935.29 or 36 you can write. Can I proceed? Proportion. 38.1 divided by 935.36. What the proportion here? 0.0407. 0.0407. 36.28 divided by 935.06. What's the number? 935.36. What's the number? 0.0388. 0.0388. 34.55 divided by 935.36 gives you 0.0369. Third or fourth decimal, leave it. You can just round it off. Next. 32.91 divided by 935.29, that's 935.36 if you want write as 0.0352. Or 52 can have it here, right, as I write here for consistency. 31.34 you should be having if I am right, is or not? Divided by 935.36 gives you 0.0335. Gives you 0.0335. 29.85 divided by 935.36 is going to give me 0.0319. 0.0319. 28.43 divided by 935.29 is going to give you 0.0304. 0.0304. 703.87 divided by 935.36 gives you 0.7526. 0.7526. Obviously, you should approximate it totaling to what? 1. Okay. Now, duration. 0.5 into 0.0407 gives you 0.0203. 1 into 0.0388 is 0.0388. 1.5 into 0.0369 is going to give me 0.0553. 0.0553. 2 into 0.0352 is going to give me 0.0704. 0704. 2.5 into 0.0335 will give you 0.0837. 0.0837. 3 into 0.0319 gives 0.0957. 0.0957. 3.5 into 0.0304 gives 0.1064. 0.1064. Finally, it is 4 into 0.7526 gives you 3.0104. 3.0104. If I total everything, I'll be getting duration as 3.4810 years. What written in the first column is what? Years. 3.4810 years. 3.4810 years. Stop writing. This is one way some books present. Hull and all present only this way the duration. Now, another way of presenting is, see, instead of writing here, they write what? Periods. I will write 1, 2, 3, 4, 5, 6, 7, 8. I'll write what? Periods. Period into proportion gives you what? Duration. I'll be getting duration as, if I write 6.9620. Correct? 6.9620. I'll be calling duration as 6.9620 period. 6.9620 period. And divided by 2 to get you what? Number of years. Everybody, are you following or not? Now, write down. Alternatively, in the first column, we can write instead of years, periods. Alternatively, in the first column, we can write instead of years, periods. And we will be getting duration as 6 point, can you tell me correctly 6.9620 above? We'll be getting duration as 6.9620 periods. We'll be getting duration as 6.9620 periods. Number correct? 6.9620 periods. Okay. Now, this is one way. Can I proceed? Write down formula. Write down formula. So, people wanted badly to use formula, na? We'll use it. Now, formula. Okay. Now, tell me the formula for calculating the duration. What is the formula? 1 plus y by y minus 1 plus y plus 1 plus y plus t into c minus y. 1 plus y by y minus 1 plus y plus t into c minus y divided by c into 1 plus y power t, c into 1 plus y power t minus 1 plus y. 1 plus y power t minus 1 plus y. Okay. Be careful. When it comes to formula, you should convert everything into periods and substitute, because substituting 10% per annum and 5% per 6 months will not be same, because when a compound, I am going to compound more number of times in what? Period. So formula always write in what? Periods. The problem is in periods or not? Now, let's substitute the numbers. Let's do it together. Now, I think y is 5% per period, so no. How to write here? 1.05 divided by 0.05. 1 plus y by y na 1.05 divided by 0.05 minus, what is 1 plus y? 1.05 plus t is number of years and number of periods. Number of, how many periods? 8 periods into, what is the coupon rate in this problem? What is coupon rate? 8%? Now, you become what? 4%? 0.04 minus, yield is what? 0.05. So 8 into 0.04 minus 0.05, the whole divided by, this number alone divided by C into, what is C coupon? 0.4 into C, 0.04 into 1 plus y is what? 1.05, power t is what? 8 minus 1 plus y is what? 0.05. Minus 1 plus 0.05. Everybody, are you comfortable with the formula substitution or not? Now, we can break up and tell me the number. 1.05 divided by 0.05. Tell me this calculation. What is 1.05 divided by 0.05 gives you what? Gives you 21 minus. Tell me the numerator. 0.04 minus 0.05 is what? 0.01. Minus 0.01. It gives a negative number. 1.05 minus negative number. Tell me the numerator alone. 1.05 minus this number. What's the number here? 0.97. 0.97 divided by 0.97 divided by, tell me the denominator simplified here. First calculate 1.05 power 8 and then reduce 1, multiply by what? 0.04 plus 0.05. Tell me the denominator 0.97 divided by the full denominator was the number? Point 06. One more decimal to cover. 0.0691. 21 minus 0.97 divided by 0.0691. Yes, 21 minus, tell me this division number, 0.97 by 0.0691. Tell me the number here. 21 minus, what number soluba? 14.0. ஒரு 4 decimal சொல்லியம்பா 0 14.0376 21 minus 14.0376. Tell me the reduced number. What the number? 6.9624. We had 6.9620. Respond yes or no. Years are periods are periods. Because I have done in periods. You want in years divided by 2. Duration is 6.962 periods. 6.962 periods. I had 6.9620. Can round out of not? 6.9620 periods. 6.9620 periods. Please respond. Are you following or not? Now, one small calculation. Last is what? Volatility. Then I'll leave you. Lot of time left. Write down next. Step 2 or step 3? Step 3. Volatility. Step 3, volatility. What is the formula of volatility? Duration divided by 1 plus YTM. Be careful. Duration divided by 1 plus YTM. I should not write the duration in years, write in what? Periods. Because it is always very important that. Okay. What is the duration period here? It is 3.4810 into 2. Because I calculated 3.4810 later on, earlier or not. I want to make it into periods. But you also add straight away the 6.962 also. It is 3.4810 into 2. There is a duration in periods. Thereby what is 1 plus YTM per period? 1.05. 3.4810 into 2, that is 6.962 divided by 1.05. Tell me what is volatility? What is volatility? 6.63%. Volatility is 6.63%. Volatility is 6.63%. 6.63%. Now, please interpret for me the 6.63%. When the YTM changes by 1%, the bond value inversely approximately changes by 6.63%. Incomplete. Let me tell you, carefully follow. When the YTM changes by 1% per period. When the YTM changes by how much percent? 1% per period. The bond value changes by 6.63% inversely and conversely. That is, when the YTM changes by 2% per annum, the bond value changes by 6.63%. Everybody, are you following or not? Is the meaning of a volatility. Write down. When, don't talk, please. When YTM per period is changed by 1%, underline the word per period. That is very important. When YTM per period is changed by 1%, when YTM per period is changed by 1%, the value of the bond will approximately be changed by, when YTM per period is changed by 1%, the value of the bond will approximately inversely be changed by, the value of the bond will approximately inversely be changed by how much percentage? 6.63 percentage. The value of the bond will approximately inversely be changed by 6.63 percentage. Respond. Are you having the clarity or not? Now, let's have a last check. I leave you. Okay. Now, check. Now, our YTM currently is 10% per annum or not? No. I'll slash it down to 8%. How much percentage? 8%. That means 2% per annum. Okay. Assume YTM to be 8% per annum. Assume YTM to be 8% per annum. Assume YTM to be 8% per annum. That means you discount how much percent? 4% per period. Yes or no? Now, the bond value is as follows. assume YTM to be 8% per annum. The bond value is as follows. Can I start or not? Term, cash flow, present value factor or annuity factor, discounted cash flow. Term, cash flow, PVF or AF and discounted cash flow. 1 to how many periods? 8 periods. What is the cash flow? 40. Coupon is 40. Discount how much percent? 4%. 1 divided by 1.04 is equal to 8 times grand total 8% divided by 2, 4%. Na? What the annuity factor is going to be? 6.7327. 6.7327. What the discounted cash flow? 269.31. 269.31. 8th period. What the cash flow? 1000. Too late you work on up here. 8 period going to be what? 1000. 1 divided by 1.04 is equal to 8 times. What is the amount? 0.7307. 0.7307. What the number here it is? 730.70. 730.70. What the bond value? What bond value? 1000. 0.1 paise leave it. It's going to be 1000. Good morning, friend. When I use the word 8%, you stop me, sir. Don't calculate, sir. The value 1000. The second time you are sleeping, same day. Correct? And a coupon is 8%. When asking YTM to be what? 8%. The bond should be trading at par. Yeah. Disappoint. Cross checking, don't say. Samalikari. Okay now. See, alertness. I could have saved this time or not. You only go to the office late. Can I proceed? Now, next. Bond value at 10%. Please. 935.29. Right. Bond value at 10%. 935.29. That's a question. I think 935.36. Question made us 935.36. Bond value at 10%. 935.36. Bond value at 8%. 1000. Bond value at 8%. It is 1000. Increase in bond value 64.73. Some number 64.74 also can have no 64.7. Okay, 72. 64.72. Leave it. 64.72. Percentage change is it changed from which price? 935.29 64.72 divided by 935.29. 64.72 divided by 935.29 into 100. How much percent? 6.92% is equal to 6.92%. Tell me what is our volatility we calculated here? We calculated 6.63. Okay, I said it's going to be approximate only. So accuracy can be obtained only through convexity. That's how one should be understanding the volatility. Next class we will do annuity bond, perpetuity and zero coupon bond and start with the bond immunization strategies.
Thank you friends. OMSAI Bhojanapalli.